Hello everyone, welcome to Price Action Basics. Today we'll just be discussing basic things about price action, why prices move and how they move, and what you should and should not do, what you should look for, things like that. This is being recorded, so if any of you miss something or have any need to review the material, you can review the recording later. So don't worry if you miss something. At the end of this session, there will be opportunity for you to ask questions and things like that. So let's start right away. So this is a standard disclaimer. There's a risk of loss in futures, forex, and options trading and trading online. Please trade with capital you can afford to lose. Past performance is not necessarily indicative of future results. Nothing in this site is intended to be a recommendation to buy or sell any futures or options market. Readers are solely responsible for how they use the information and for their results. 9trans.blogspot.com does not guarantee the accuracy or completeness of the information or any analysis based thereon. So let's get into this right away. Imagine that you're trading some instrument, maybe it's soybean or gold or something, it doesn't matter. And for a long time, for a long time, say 6 months, the price is only moves one tick. Okay, so they're buying here and they're selling here, and this is what happens for 6 months. Okay, after a while, if you ask yourself, how can I make money in trading this instrument, it's pretty obvious. You have to buy here and you have to sell here. You try to do anything else, you will lose money, right? So this is a one tick bar, and the reason I'm saying 6 months is to give a sense of perspective from the viewpoint of trading algorithms. So for an algorithm where each candle is 1 millisecond, a 5-minute bar is like 6 months. It's around the same time scale. Okay, so imagine that this is what's going on for a long time, and you would just have to put limit orders to buy here and limit orders to sell here, and it doesn't matter which one gets executed first. Which one gets filled first. If the buy gets filled, then when it hits here, you're long and you're filled and you make a profit. If the sell gets filled first, when the buy gets hit, you essentially completed a short trade and you made a profit. Okay, so now imagine after a while, say after 3 or 4 months, you see that most of the trades are occurring only at this tick. There is nothing at this tick. It's just this tick. So you will begin to wonder what you should do. So if this is soybeans and you're a farmer, you are happy because you are getting the higher tick. Okay, the reason I use soybean is when you're a farmer, you have some soybean, and you have to sell it. If you don't sell it, it will rot. And if you're someone who makes tofu, you have to buy soybean, otherwise there's no tofu to make, right? So there's an inherent demand and supply in the market, and it ensures that trading takes place. So if you are a buyer for whatever reason, when you see the price here all the time for 3 months, you may be forced to buy here. Okay, and now if you're a trader and you notice this, you realize that the price is not coming here anymore. You may think, well, I should also buy here and maybe sell one tick above over here. Okay, and if after 6 months this does indeed move up there, you can be sure that a lot of traders who bought here will sell it here. and this will cause the price to fall back down into this 2-tick range. So that essentially is your breakout attempt and failure. So a lot of times what can happen is people, traders who bought here try to sell that, but they don't get filled. The price comes back into this range, into this 1-tick range, or even goes down here, and these traders may get filled, which will cause the price to move back again. So this sort of equilibrium exists in the market most of the time, but occasionally what happens is that the price which was ticking here, when it ticks above, will continue to stay there. So instead of oscillating between these 2 ticks, it will now oscillate between this and the upper tick. So essentially you would have a 2-tick bar like that. Okay, so you would, the bar would just keep going up and down. So ignore this little bar for now. So so the bar would just be oscillating in the upper part of the of this region. And if this continues for a while, and prices continue to trade at this upper tick for a little while longer, then the same thing can repeat, and buyers will start buying here, and it will go up one more tick, and the whole process will continue. So this is how a trend sort of starts out. So instead of keeping this bar for 6 months, let's say we decide to we pause the recording the bar at a certain time. So let's say about 15 days, or it could be a month, or it could be 5 minutes, does not matter. So we sort of freeze the bar here and start printing the next bar. So that is basically what a chart is. Okay. And once we start doing that, we may notice the historical movement of the price, and if we see something like this, we would see a 3rd tick, we would realize that, well, this is sort of like a breakout. This is trending behavior. Buyers are buying earlier and earlier. Okay, so the natural demand and supply of the commodity that you're trading would be reflected in the charts that you're printing. So if you look at any bar, this is a representative bar of any chart that's a candlestick chart. You are likely to see a tail above and below, and you'd see a body. If the body is very small, or if there's no body, it would be just a horizontal line here, and it would be all tails. That would be a doji. If there are no tails, it would be a shaved bar. If there's no tail on any one end, it would be a shaved bar. And they all mean something. Okay, and they all give you some information. The information here is that I can decompose any bar into its constituent price action. So here it's pretty clear that the price opened here at the beginning of this bar, went down here, then went all the way up here and closed here. So this is what it would look like if I could break it down into 3 pieces. If I were to break the bar exactly into 3 pieces, it may not look like this. There may be a tail here, or there may be a tail there, or something like this. But for our purposes, what has happened is there was some selling, which met with a strong buying and some selling. Okay, and so essentially any tail is a pullback in the direction of the trend. It is a little pullback, and that's why when in a chart, when you get the first tail, there are a lot of traders who will simply buy the close of the bar and expect it to continue to go up, because they see it as the first pullback. So here's an example of what this is actually a 5-minute chart. This is from a recent day. this is what would happen if you break down all trading activity on ES by 5 minutes throughout the regular trading hours. Okay, so at every 5 minutes we print the bar and we just create a new bar. And does it matter whether it's 5 minutes or 7 minutes or anything? No, because so for example, these are three charts. One of them is a 15-minute chart, one of them is a volume chart, and the other is a tick chart. And for all practical purposes, they look the same. That's because it does not matter where you stop recording a bar and start recording the next bar. Essentially, price action is determined by the relative strengths of the close of the bars and the relative position to each other. Okay, so when the price is trending, it will look like this. There'll be very little overlap, and the moment the bar closes, they'll start buying. Similarly here. And when the price is not trending, or when the price is in a weaker trend, it will look like this. Okay, so it doesn't really matter where you stop and start. There is no magical value or magical property of the 5-minute chart. Or if someone says, well, I'm using 4500 ticks and it gives me better results. Well, if it works for you, great, but mathematically there is no magic to any kind of number. All numbers are just the same. They just the relative differences between numbers is what's important. So coming back to bars, this is actually a very small day. This is a 5-point day. This is a terrible day for trading, but this represents a great cross section of all kinds of bars that you would see. The first, we have a reversal bar. A reversal bar, in a good reversal bar should not have a lot of overlap. But when you have a gap on the open of the day, and this is after a breakout of a weak trading range here, these two bars represent a tiny trading range. It often works enough during the open. But I'm just going to use this as a reversal bar for the shape. There was an attempt to go up, and there was a sell-off. There was a strong sell-off, and there was a close near the bottom. Okay, and there was only one tick tail. So if you look at almost any chart, you will see that the most of these big moves go off shaved bars. Like here. I mean, this is not actually a good chart. There's not really a lot of big moves. But even on this day, the big moves went off shaved or bars with one tick tails. And the reason for that is very simple. The reason is this. The reason is when a trend begins, prices will continuously go up. There'll be very little pullback. There'll be a tick or two pullback at most. So just imagine all these bars when they are trending, the pullback is just a tick or two, and it continues to go up because they are buying, just like we spoke about here. They are buying every small pullback. They're buying, and that's what causes a trend. So when you have something like this, there's a good chance that a trend is beginning here. Okay, so signal bars, strong closes are usually a very important necessity for trends to begin. Can a trend begin without strong bars? Yes, of course it can, but they are rarer. Okay, so so we all know. I mean, most of you already know what these bars are and what they mean. We have a barbed wire, dojis. This OIO is a kind of reversal. It works like a micro failed breakout. So this is the inside bar creates a tiny trading range, and there's a breakout, and it fails, and that can make it move up. I mean that can make it act like a reversal bar. and so on. There's IOIs and you can, all these are standard bars that you already know about. But you'll notice something special here. You'll notice that once this bar closed, even though it was a shaved bar, it did not trigger. They just started selling it. Similarly, after this bar closed, they just started selling it. Okay. So for some reason, traders know that they should just sell here. They should just sell. They should not try to buy or do anything else. They just sell here. So what's magical about these bars or these prices that traders are unwilling to buy above it or even cautiously wait to see if there's a reversal bar or something like this? So the reason is there are a few reasons. One of them is, for example, here, many traders were caught unaware of this trend, and when they saw this bar, they saw this as their opportunity to get in. Also, traders who bought here trying to fade this breakout saw this as a chance to get out at a better price. So the moment this bar closed, they sold it. Okay. So in general, I think there are traders who trade certain time frames or certain a certain kind of certain number of volume or certain number of ticks, and they do make decisions on the closes of bars. So my opinion is most trading would be a lot simpler if you make decisions only on the close of bars. So anyway, we already spoke about bar composition, and if you look at these bars, it should be fairly obvious that these bars on a higher time frame represent something like a doji. So a trend close here does not actually mean anything. Okay, so this is still mid trading range. So although in a sharp move down and reversal, or you can bank that this could be the beginning of a trend, a breakout of this bar could lead to a move up. In a horizontal movement, this whole thing is meaningless. And the reason is actually fairly simple. So, for example, this is a 1 bar trading range. They bought somewhere here, they sold somewhere here, so this is all trading range. All these dojis are trading ranges. So a bar that's enclosed by a trading range is still a trading range. And to actually trade a breakout from a trading range, you have to take the second attempt. You have to take the breakout failure. So even if you take nothing away from this webinar today, take this: when there's an overlap, all signal bars are suspect. All this is just one big doji, and if you try to buy above this, you are basically buying the top of a doji. Okay, trading within overlaps and barbed wire has cost me more money than anything else that I've done. So what kind of chart to use? You can really use anything that you're comfortable with. So if you take a chart that's too fine, like if you take a 30-second chart, you're not going to see bars. You're going to see just horizontal lines every few, there'll be a lot of gaps and there'll be tiny bars. It's untradeable. If the time frame is large, your bars will be very large. This 3.5 points, there's a lot of risk, when you enter a signal bar like this. If you are like me and you like to risk less and try to get a lot, you are better off with a 5-minute chart like this, because even on a bar like this, you have about 2-point risk at the most. Okay, so the reason, when you look at this chart, you will see that, the moment the price approaches some point, it gets sold off, like that. So here, this is sort of this invisible line that that seems to attract selling. Similarly, this or this seems to be an invisible line that attracts buying. Okay, so we can call them support and resistance. We can call them anything we want, and we don't know why. We don't care why. You don't see the chart anymore. Okay, hold on. Do you see the chart now? Okay. Yeah, so basically, let me just repeat that. So you see, visually, if you look at this chart, you can see that the moment the price hits certain points, it seems to attract selling. It seems to attract selling here and here and here. And similarly, the moment the price reaches this line, it seems to attract buying. And we don't know what the reason is, but traders like to call them support and resistance. And most of the time you have no idea how long this lasts. It could last all day here, like this day, or it could just break. Okay. So these are support and resistance, and once you have a support and resistance that are horizontal, the price action is contained between them. That's a trading range. And if you zoom out, if you make this whole thing into a 6-month bar that we saw earlier, you realize that this is the bottom of that one tick bar and this is the top of that one tick bar. And you should only be buying here and you should only be selling here. So once you realize that, you will, realize the danger of trying to buy anywhere here. Okay. If this is buying and they're trying to buy near the high of that bar, and you won't realistically expect a profit. So the thing about support and resistance is price doesn't always touch it. It can go slightly above or it can go slightly below, and there is no guarantee it is not actually a very thin line. It's actually usually a very thick band, and the price can penetrate it to various degrees. So when the range is very tight like this, you should treat it as a one tick bar, and you should not really you should only be buying near the bottom of that and selling at the top of that. When the range is so small, if you buy here, you have to realize that your profit is, just like our previous example, it was one tick. Here it will be very, very small. So when the range is small, it's best not to do any trading. Okay, you want to wait for the range to get larger. The probability of exiting at a profit is higher when the range is larger. Otherwise, this is just one big doji on a higher time frame, and it should be pretty obvious. It opened here, went down here, and it closed somewhere here. So this whole thing is one big doji, and you don't really want to buy in between a small doji. Okay. So what happens when the price and support line is not horizontal? You get a trend. Okay, so this is basically a support line, except that the support line is sloping down. It's still attracting the same behavior. When the price touches that line, there's just buying. When the price touches the other line, here the line is not very clear, but if this would reach somewhere up here, we would see that it would attract selling. So this is a trend, and the thing about a trend is this is what happens on the bar that we saw earlier. people are, traders are entering before it reaches the extreme, the prior extreme, and they are holding on longer before exiting. So the pressure, the overall pressure, the overall shape may be the same, but the overall pressure is downwards in this example. And that means that up moves are smaller and down moves are larger. So when something like this happens, it's obvious that you make more money selling here than you would by buying here. Okay. So in case of this rather wide channel, you could probably still make a few points buying here, but a lot of trends are narrow. They're not they're not broad like this. So a lot of trends are actually like this, especially bull trends. So here, if you were to sell somewhere here, you would not make a profit. You would be stopped out. Similarly, every new high, if you short, you wouldn't even reach 5 ticks a lot of times. You did make a couple of points here, I suppose, if you had the patience to hold through all this. But in general, you're better off buying along the direction of the sloping. Okay, so let's say you bought somewhere here and you want to get 2 points, and here it just you'll be filled here. If you bought somewhere, even if you bought here for whatever reason, you bought about this bull bar, the first push-up did not fill you, but that's okay. The next push didn't fill you, the third one did. Okay, it filled your target. Similarly, if you bought here, maybe you didn't get filled on the first push. You can simply wait out for the next push. If you are trading counter trend, you cannot wait, okay, because the next push will most definitely take out your stop. So this is why counter trend trading is harder and more dangerous. You're also buying. So this is the end of the range. You are buying already at a disadvantageous position. Okay. So I generally try to buy with trend, and I like to stay with trend. And a simple way to do that is to buy near the trend line. Basically you wait for it to poke the trend line and give a setup. So the EMA often works as a dynamic trend line, a trend curve, if you will. Okay. So even if it pokes the EMA and it's close enough to the trend line, I will often consider a trade, especially a first leg. So for example, here, it's a big gap down, and this could be seen as a bear trend, and this entire trade push can be seen as a pullback. So when there is no trend line to draw, the actual trend line from the prior day could be coming somewhere here, but because the EMA acts like a dynamic trend line, when the price hits here, if there's a decent signal bar, I may consider selling here. Okay, but here, all these were bull bars. You should, I never short below bull bars. It's usually a low probability trade, and we're probably going to go over time. So anyway, you have to buy near the trend line, and yeah, so this acts like a dynamic trend line, and if there's a good signal here, you could buy it. But once you have a trend line, you should always try to buy near the trend line, and you should always try to buy deep pullbacks. The reason for that is if the pullback is shallow like this, it usually gives a deep pullback right away. So you're not missing much by not taking the deep pullback. Okay, I mean not taking the shallow pullback. Similarly, if there's a lot of overlap, here, there's a lot of overlap here. The breakout, although even if it's strong, it will usually give you another setup close by. Okay, so this is only about like a few ticks above this, and so on. So once we know how price can move, we realize that there's basically only one thing you need to be aware of. Is it trending? Is the market trending? Has the trend possibly terminated? Like here, by this horizontal flag, or this, has the this could also be a termination. This is a wedge and double top. These are signs of termination. If it has terminated, if it's terminating, you have to get out, and then you have to wait for a new breakout. So here, this is a possible breakout, and this is a pullback after breakout. So you can basically you basically are trying to be aware if there's a trend, and if there is a trend, you're taking with trend setups. If there's no trend, like if it is something like this, horizontal movement, this is a trading range. If the range is small, you just don't do anything. It's not worth doing anything when the range is narrow. It's a very high probability of failure. If the range is large enough, imagine this whole thing was a trading range somewhere here, then you could consider a failed breakout setup or a breakout pullback setup. So when I say, wait for a breakout, the breakout bar has to be very strong. Very strong means, it breaks out, at least 4 ticks and has a very strong close. Ideally, more than half the bar is outside the, outside the breakout point. So that is a strong breakout. That meant that all the supply here was cleared. So we have basically cleared all the sell orders here and moved well past it. Okay, and after that there is a much higher probability that if any pullback after that will exhibit trending behavior. If the breakout closes, for example, if this was the high of the day, this is not actually a very good example, but this is actually so this was the high of the day. We broke out, we closed just 1 tick above, and this particular bar is the minimum what you can call a strong breakout. It had tails. It closed only 1 tick above the prior swing. It had tails on both ends. This is a very borderline bar. Okay, most of the bar is still within the range and so on. So this signal is a possible failed breakout signal. And the only reason I didn't take it is this was essentially one-legged. There was no L1 or anything like that. And I thought, this is too far from the EMA. So like I said, EMA is a dynamic trend line. You really want to, sell over there. So, that's why I didn't take it. But that's essentially a failed breakout. Okay, so you are essentially looking for trend terminations, like here, looking for breakouts and new trending behavior. The reason, the reason you have to wait for a good breakout is after that, simply the market inertia will simply keep pushing prices higher and higher and higher, and you have a higher probability of success. Over here, anything you do, once this trend terminates here, almost anything you do has a high probability of failure. So if you bought here, it didn't get filled. Only if you had the if you were able to hold through all this, you could get fill on your target. Any sells here or here, they all fail because this is all the trading range. All these are low probability trades, and you'll only see just 2 legs up and 2 legs down, and there's no guarantee that any swing point will be taken out or anything like that. It's very, very low probability. So essentially you are waiting for, you are looking out for trend breaks, trying to be aware of whether the market is trending or it's just moving horizontally. When it's trending, you can look for reversals. In general, reversals should be very obvious. There should be a very strong overshoot, or there should be a very sharp trend break. The first trend break is usually a pullback. Okay, so this is the first deep pullback. This is usually a buy. If this was a bull bar, I would have bought it. But in general, there should be the reversals should be very obvious. If you had asked yourself if this is a reversal, it probably is not a reversal. If there was a strong movement, if the first leg of the trend was strong, it's probably not a reversal. Okay. Generally, when there's in bull markets, when the opening is weak and when there's a weak move that is bought, it will usually like to trend all the time. It will generally trend till the end of the day. Okay, it's only in bear moves that everything moves. All moves can be sharp and unpredictable. Anyway, so yes, this is a micro. This is L1, but when the price is not ticked below this, generally you can expect another leg up if this is very far away from the EMA. So I will get into more of that later. We will try to cover that later. So in general, so this is sort of what is going on in my mind all the time. Okay, if the trend is up, I'm looking for pullbacks. If the trend is down, I'm looking for pullbacks, and sometimes I'm looking for reversals. Okay, if the trend is up and I think it may go down because there's an obnoxious overshoot of the trend channel line, I'll think of a reversal. But usually I'm looking for pullbacks. If it's flat, I'm looking for breakouts and breakout pullbacks. I will usually assume when the trend is very narrow, I would assume that everything will fail. I won't be trading anything. Okay. If the range is wide and there's a failed breakout signal, I will probably take it if I feel comfortable taking it. So in general, simply because of market inertia, the tendency of the market to continue to do what it's been doing, these are the highest probability trades. They go here. When reversals are obvious, these are also okay. These are, if with some experience, you can also trade them these very successfully. Okay. Trend termination is something you have to get used to, because once the trend has terminated, these will start failing. Okay. So, for example, here, this horizontal movement and, successful succession of dojis and this failed H2 here, you see this, it gave a poor H1 signal and a poor H2 signal. That is usually a sign of trend termination. So this is a good point to exit on the close of this bar. If you bought anywhere here, this is a good point to exit. So you should always be aware of when the trend is terminating. That will prevent failed continuation trades. That will also tell you when to watch for breakouts, and when the range is large, when to wait for breakout failures. So in a trend, you're looking for this and this, and you are cautious about this. Once the trend terminates, you're waiting for this, and you're watching out for this. That's basically it. So you need three things for a trade to be successful. You need a good location. You need a pattern or what we call setups, a two-legged move or trend channel line overshoot or anything else. You need a pattern, and you need a strong signal bar. A strong signal bar for me is a shaved body with a shaved bar on the entry side with at least a 2-tick body, or at most 1-tick tail with at least a 3-tick body. So in my experience, these are the best signal bars and will lead to trends, can lead to trends. The only exceptions are the first reversal and first pullback, where I am very liberal about the signal bar formation. The reason is not that they are high probability just because they are first reversal and first pullback. The reason is my risk is about 6 ticks, but my expectation on that trade can be 4 points to on a good day it could be 8 points. So for me, it's worth the risk reward, even with the poor signal bar, if if everything else is decent. So what does location mean? Location is fairly simple. Location is I basically don't want to buy overlaps. I basically don't want to buy. So this whole thing is a doji. So you can tell from the bar composition, example earlier, that this whole thing is a doji, right? And you don't want to be buying here because it's very risky. Yes, it can break out like this, but when the pullback is deeper, it's fairly more obvious that this is there's a higher probability trade. So what I want is I want a pullback to either the trend line or the EMA. Okay, and I want it deep. When I say deep, it's a bit subjective. It's a bit subjective in the sense it has to be deeper than the average bar, and I should I have to adjust my expectations based on how deep the pullback is. Okay, so if the pullback is something like this, or if I consider this is a pullback, this is a it's a 2-tick pullback. I mean 2-point pullback. If the signal bar closed here, that's 2 points. That would be ideal. I would just buy it blindly because this is a reversal. This is the first deep pullback. It would make sense that it would at least give me my 2-point target. When the trends are hard, like this, if you have a pullback like this, this is almost 2 points. This you can take with the comfort that at least it will test the prior, even if it only tests the prior swing, you have your target. If the pullback is shallow, like this, you have no idea. It may test here, but you won't get a fill. And if it goes up for another leg, you will be stopped out. So even though this was near the EMA, when you really want a deeper pullback. So the last requirement is so the last kind of support is high lower close of prior day. Okay, so the reason, I really avoid believing in any kind of pivots or magical support lines or power zones or anything like this. The reason is they work enough number of times that you think that they have some value to them, but it's not a high probability setup. It may be a greater than 50% probability setup, but I believe that the trend lines and EMA are much higher probability. If you can read them correctly, they are 70 plus, and some of them are 80% probability trades. The high, low, and close of the day, on the other hand, of the prior day, there are good reasons to believe that these can be turning points. And the reason is a lot of algorithms and a lot of traders, when they want to buy something, they will place a trade at the close of the prior day. That's just how it works for them. That's, they're trading on the daily bar, and buying or selling the close of a bar is a standard practice. So if you had a bull day, yesterday, and the price opened at a gap up and it pulls down to the close of the prior day, there's a very good chance that a lot of buy orders would be filled and the price would continue to move up. Okay. Similarly, when the day is large, or even on an average day, when someone wants to sell and they have seen the range of the prior day, they want to sell. They don't want to sell at the open. They want to sell near the high of the prior day to get the best price, or they want to buy near the low of the prior day to get the best price. So the high, low, and close of the prior day, they do act as essentially, you can look at them as points where traders who trade on the daily charts will act, and that's the reason they work. And they only work once, in the sense, the first reversal, the first time it approaches at the high of the day and takes it out, it has meaning. And after that, if it does a lot of movement and then comes near the high of the day, but not the high of the current day, it has much less meaning. Okay. So why do we need location? We need location because we are always trying to buy near support or sell near resistance, and we believe that those are very good entry and exit points. So just like in our 2-tick bar we saw earlier, you really want to buy at the bottom of the bar and you want to sell at the top of the bar. Similarly, in a trading range, you want to buy near the bottom of the range and sell near the high of the range. Our trend is nothing but a sloping, support and resistance line. So just imagine the 2-tick body is, instead of having a horizontal top and bottom, it has a slanting top and bottom. So you just want to, buy and sell near those points. And we already discussed signal bar, why strong closes are indicative of possible trending behavior. So the last is the pattern. Okay. So when I say pattern, essentially it's this. It's your setup. It's your trading setup. What do you see? What reason do you see to buy or sell? So in a trend, for example, why is a 2-legged pullback an indication to buy? Why is a 2-legged pullback at support an indication to buy? It's an indication to buy because when the first leg terminates, when it takes, let's go here, for example, so this is a first leg, and when it ticks above this, that means the buyers have convinced the bears that this is not going to be a trend. We have taken this out. We have, so in a trend, as we saw earlier, in a trend, bars simply do not come below each other. It will just, it will just keep going up like this. There's a very little overlap and it just keeps going up like that. So something like this. This is a trend. Once it ticks below the bar, like here, once it ticks, once it takes out the extreme of any of this bar, the buyers have convinced the sellers here that there's going to be no trend here. Okay. And then they will retreat to allow these sellers to exit at nominal price, at a decent price. This will also allow the buyers to enter at a decent price. Okay, so if I was short here and I see that this is, one of the bars has been taken out, on the next push down, I will simply exit. I will simply exit just on the breakout of this bar. And that's what most traders are doing here. The shorts here are exiting here. So this is basically why two-legged pullbacks to the support are are such a good setup. And that of course needs to be in a trend. If it's in a trading range, it doesn't mean anything, right? So this is my setup chart. You can I will put this somewhere on my website where you can download it or whatever. You can keep this on your trading screen to as a reference. These are all my setups, and these are some notes I've written on the setups. You guys are probably familiar with all the nomenclature here. The C is confidence in success for an average trader. So that means 5 is you can get with some training and practice, you can get very good at trading this. 3, this is going to be hard for a while. This is going to take a while. 2 is going to take a lot of expertise. This is a very complex setup. So I've been working on breaking this down into 2 or 3 different setups. So this may no longer apply. Once I break this down into about, I think, 3 trades, we could bring this up to 3 or 4. And you guys are probably familiar with all this. This is a two-legged move to the EMA. This is in a channel. This is the first channel breakout. This is a hard H1, which is in a hard trend. This is the first pullback, the first attempt to break to a new high. Gap to breakout test. This is trend termination, failed breakouts, wedge, first pullback after wedge. This is major reversal. I don't actually treat this as a separate setup. For me, when a trend breaks, it turns into a trading range, and the test of the extreme is a failed breakout trade. And if the range is small, I will not take it. There are 3 kinds of breakouts. I discussed breakout pullback earlier. There's also triangle breakout and expanding triangle breakout, which I've discussed on my blog several times. Failed breakouts, double top or double bottom pullbacks. This is basically a reversal bar right after a breakout. So, like here. So you had a reversal bar and you have a failure signal right away, after breakout bar. That is a possible setup. This is a wedge failed breakout. So a large trading range. Breakout is not one-legged. It goes in 3 legs or so. These are how trends terminate. A double top or double bottom that triggers a TTR. We saw basically here. So this is a possible trend. This is a reversal, and here suddenly, it turns into dojis. So when you see a lot of dojis, the trend has probably ended. Okay, that's one way to know that the trend has terminated and turned into a trading range. And this is the last one, when you get a poor reversal signal and a poor continuation signal that don't go anywhere. Okay. So these are basically my setups, and one of the most important things to note is that the pullbacks have to be in trend, and they have to be deep. They should not be horizontal. Horizontal pullbacks either fail, or if they succeed, they will give a deep pullback right away. So don't worry about missing shallow pullbacks or horizontal pullbacks. First channel breakouts need to trigger right after the channel bar. If it gives another break, if it gives another bar down, usually you should look for 2 or 3 legged pullbacks. So there is insufficient time to go through all the setups. We will have another webinar where we discuss all the continuation trades, all the reversals and things like that. I think we have about 5 minutes or so for questions. If you have any. Just type it into the chat window. No questions. Oh, yes, there's one. With bar, when is a bar too big to take it as a signal? Bars are whenever a bar is larger than average. You have to consider it's so you should always be aware of the principle of the one tick bar. Okay, when the bar when the bar is large enough to make the pullback shallow, it's too large. When the bar is when the bar is much larger, even here, for example, I would consider this a very large bar. I wouldn't buy here. This is, compared to a recent bar, this is not that large. In the old days, I would, keep my stops below this, and I would probably not trade a bar like this. But past, in the recent past, I have changed my trading style to take only 6 tick risk, no matter how large the bar is. So for me, the actual size of the bar does not matter. What matters is the relative size to the prior bars. Hold on, a lot of questions. Let me just try to get to them. Given that traders make decisions on the close of the bar, surely the time frame you choose for the trade is important. Yes, it is important. It's not important in the sense you will see them making such decisions on nearly any chart. So you will see formations like that, when the bar just closes and they immediately sell off. You'll see that on many charts. When I say they make decisions on the close of the bar, I think it applies to extremely commonly traded time frames, which is 5 minutes, 15 minutes, hourly, half an hour. For a tick chart, usually it's harder to make that distinction because sometimes a couple of ticks, here a couple of seconds accuracy loss in the close won't impact this dramatically, but in a tick chart it can impact it, by a few more ticks. So does how much does it impact the time frame? I wouldn't be able to tell you exactly, but I do think what I've observed is you can really trade any time frame where you're comfortable with the risk. How long do it take you to be profitable? That's a very good question. I have swung between profitability and unprofitability multiple times, and because I have the habit of experimentation. Every time I became profitable, I continued to experiment with something else, and that would move me back to break even, or some months even losing. I was a losing trader and so on. And I wouldn't say that there is such a thing as suddenly being profitable, that a trader will trade for a while and suddenly turn profitable. It doesn't work like that. You will start being profitable on certain setups, and over time you will you will have 2 or 3 setups where you're consistently profitable. And if you just stop trading everything else at that point, you are a profitable trader. But human beings being what they are, they will continue to try new and new things until they feel that they can capture all the market moves, and that's basically um, what happened to me. All on my proven trades, on whatever you see on my setup chart over there, over here, I've been profitable for a while on this. I have no idea how long, but I've still been experimenting with all sorts of things, limit entries, trying to capture the early move on a gap. So some days there'll be a large gap and it will just take off from there. And pre-market entries, and most of them have been losers. So even though I have won on these setups, so this is why I call them proven setups. Proven setups means that I know how to trade them, and a lot of my experimentations, actually most of them have not been profitable. So only these have been, and I've figured out how to trade these. And now that I've stopped experimenting, it's been much better for my bottom line. But even now, occasionally I get a impulse to try something. When I see something that I've observed, I think, well, I should try this. And this is natural. Most people are curious and they want to see what happens and things like that. But if you look at trading as a business, it's a dangerous thing. It's best to, I think for most people, it's best to just start with one or two setups and just be consistent. I'll talk about consistency and profitability and risk management in another webinar. We really don't have time right now, and I'll try to discuss more on that. Do you think traders make decision on the end of the 5-minute bar more than 3-minute bar? Yes, I do think they do. Traders who trade smaller time frames, or they tend to hold for shorter durations. They tend to be more impulsive. Traders who trade on longer time frames, the hourly chart or whatever, all these institutions, they tend to hold for longer. They tend to have a bigger stops and things like this. So I think the bigger the bar, the more traders will make decisions on it. Why do traders allow others to exit so nicely? It's because it's mutually beneficial. It's think about it. For example, here, once it ticks above this, at this point, the sellers know that this is not going to drop to a trend. The buyers also know this is not going to drop to a trend, but the buyers know that if the price comes back here, they can add more. Okay, so and they know that the sellers will also buy back their positions here. So that's a great entry. So they will buy it over there. They're not being nice, so, and this may not be their reasoning. Their reasoning could be something else. For example, they may see that this has an overlap and they're buying under the overlap. So every pullback is, creates an overlap, and you could buy under it. So for example, the first pullback here, this L1, now creates an overlap here. This creates a little trading range, and they may want to simply sell above it. So it could be something like that. Could you give some examples on the first two-leg higher low, lower high difference between? Yeah, so I would like to make that a part of my next webinar, where I will discuss various common and high probability setups. Where will be the recording located? I will put a link for that on my blog. The previous webinar, unfortunately, I was unable to record. I was on a Mac, and GoToWebinar does not support recording on a Mac. But in the future, I'll try to record all webinars. What's the difference? How to treat the opening bar depending on the size of the gap? Yes, so you can just take the gap as one large bar. So if it opened, so let's say the prior day closed here, you can take this as a breakout, and this as a breakout pullback, so you could buy here. If it was here, you could take this as a breakout down, and this as a pullback short. So it usually works most of the time. Okay, if there's no gap, so in this case actually there was no gap. This actually is bar 81. Usually what happens is it will simply act as a continuation of the prior day. So if the prior day was going up, it will continue to try to go up. And here, it sort of did, failed H2 and maybe failed H3. This is sort of a wedge. So, then it sold off. What setups are appropriate setups for daily or weekly charts? So the thing about daily charts is there are so many gaps between each bar that I find them hard to read. And I would rather, if you're looking for long-term, if you're trying to hold long-term, you can look at the weekly charts, and if you're looking to hold for years. If you're looking to trade for a month or two, hold a position for a month or two, you can set the time to 1440 minutes, 1440 minutes, and that will give a better chart. You can do so. In general, what you want to do on larger time frames is, if you are expecting a reversal, you just always take the higher low or the lower high, and any pullback to the EMA, any deep pullback, any pullback that's deeper than a couple of average days usually work very well. I have trouble figuring out when a break of a trend line is significant and whether or not I should be looking for counter trend trades or continue looking with trend. Can you please talk about this a bit? Yes, as I said, when there's when the first trend line break, usually if the first leg is steep, for example here, up to bar 25, it's a steep leg, and this looks like a trend line break, but the first break is usually a deep pullback. Okay, and you should always take a with trend trade. In general, if you only take the higher low after reversal, it will save you from a lot of heartache. So for example here, you may think, oh God, broke the trend line and this is a test of the low, and this is a second attempt to reverse that, and I'm going to buy here. This is a poor setup. You basically you were near, this is a poor bar. Yeah, this is near this is near a trend channel line. So all that means is you'll see a pullback. It doesn't mean you'll get a reversal. And for all this will just start channeling here. It could this could work like a spike, and this could channel. So if you wait for a higher low, a lot of times you will have better luck. The second thing you can do is you should wait for a swing point to be taken out. Like you want to wait for this to be taken out. And for example here, this would be the swing point. Okay, you see how it wasn't taken out? So if this was taken out and then you get a pullback to a higher low, that is a better setup any day. Okay, so when I say swing point, the price should move to a new extreme. So for example, a pullback from here, it should move to a new extreme. Otherwise, it's just a pullback. So here, for example, this is just a pullback. Okay, so this did not go below this, so a breakout above this is meaningless. Okay, I will try to speak more about those on a future webinar where we can discuss various setups for this is meant to be just the basics of price action, where you learn to where to avoid trading and where to actually look for trades. So so anywhere there's overlap, you sort of try to avoid. and once it starts trending, you can look for reversals or continuations and things like that. Because I see most people they trade here and they say, well, I try to do A2 here or something like this, and the reason it failed is A, it's not a deep pullback, B, it's a poor signal bar, 3, the location is very poor. Although this is an EMA, this is a very shallow pullback, and any EMA in this situation is not really good. If the EMA came from here, like this, for example, this is a much more reasonable situation. Yes, there are more webinars coming as long as I have time and I can afford the effort to make all these presentations. I will continue to keep giving webinars. I am pressed for time. I am working on a couple of other projects, but I'll try to keep making these webinars. Does the entry bar have to give a signal on the next immediate bar? Entry bar have to give a signal. I'm not sure what you mean by that. Entry bar does not necessarily give a signal. I mean, this is just something like this is an entry bar. I'm not sure if you mean it gives a signal here or it gives a reversal signal here. It doesn't have to. It can just just go on trending. I work from 7 to 5 p.m. EST, so the ES and the SPY is not an option to trade. Where have you seen something like SPY after hours? Usually, things that trade on the European markets, you can probably trade before 7 a.m. Like 6E or gold. Trade well during European markets. For you, it will be unfortunately 3 a.m. or something like that. If you want to trade after hours, there is not much. Unfortunately, when after the U.S. markets close, there's nothing until Japan opens. So unless you're willing to trade from 5 a.m., that's what I used to do when I was on the East Coast. I used to work at 9:30, 10, so I used to trade the euro, 6C futures early in the morning. It will usually trend very well during European the European market. How would you identify a pullback from a trend line break using daily charts? It's exactly like any other chart. You draw a trend line from from anywhere you see a major move up, any sharp move up, and you see a how do you distinguish between a pullback and trend line break is probably what the question is. Yeah, when there is a trend line break, it's usually pretty obvious. If it stops, a trend line break needs to be pretty extensive. It needs to be. I have a couple of posts on the blog about that. It usually goes for many bars and many points. If it's just 2 or 3 bars and just stops, it's probably a pullback. What are the important things to have in our trading plan? Oh, there's a lot of things. I will certainly make. I'll have a webinar about general trading. Like risk management, position sizing, and all these other things. Definitely, we won't be able to cover all that right here. Are you making a living? Blah blah blah. I want to make full time. Am I making a living? No, I'm not making a living trading alone. I have a full-time job, so I cannot yet just trade for a living. I'm working on, and so far I've been working on being consistent and trying to figure out a lot of things. Trying to prove my setups So I'm working on increasing my trading size for this year. So by the end of this year, my guess is, or my hope is, I will be able to trade size, and I will have proven to myself that I can I can make a living trading full time and doing nothing else. Any recommendations for trade setups on the daily and weekly charts? Yeah, daily and weekly charts, again, it's we'll try to cover that in a future webinar. I don't have enough material with me. I will try to get some daily and weekly charts. What setups would you use for option trades? Option trades is the same as anything else. Always take higher low, lower high or lower high or higher low, because if you may see something like a reversal bar, it can just continue to go on forever, and your options will lose value very quickly. You could sell options. That's a very good way to earn income. You could buy a volatile stock that has decent for example, in a bull market like now, you could on a pullback, you could buy some stock that you think will continue to keep going up, and every time it crosses a trend channel line or comes close to a trend channel line, you can sell options, and when the price pulls back, you can buy it back. That is, I feel, a much safer way to trade, simply because if nothing else, time is on your side, and the time decay will work in your favor. Friday would be a good day to go over trendline breaks. Okay, Friday. Do I have Friday? Unfortunately, this is not my trading PC, so I don't have all the all the charts and everything here. So we have to we'll try to do all the setups. We'll try to do a lot more on specific setups in a future webinar. Option trades a few days to a week. What's the time frame and setup recommend? Options are a whole new game. I'll try to cover that in a future webinar. Does a trade have to trigger on the next immediate bar after the signal bar? For me, I'm very suspicious when a trade does not trigger. So remember, for example, I think that, for example, if someone thinks this is a setup bar, if traders immediately sell that off, I'm very suspicious, because if they look at the setup bar as an opportunity to do the opposite, if they see a bull bar and if they just sell it instead of buying it, I'm going to be very concerned. So I usually avoid them. I usually wait for a second entry. What are some reasons to re-enter after being stopped out of a trade? There's no reason usually. If it's an overlap, if you're stopped out, so when you're stopped out, the first thing you have to ask yourself is this an overlap? Am I just messing on a higher time frame doji? If so, you just wait for two swings. Okay, so that will bring clarity, and that will bring usually a better setup. If on the other hand, it was if it was a decent setup, and for example, let's say I bought here, let's say here, for example, I bought here, and it took me out, took me out and closed back up here. At the end of this close of this bar, I realized that this it's just this is still a valid setup. I can continue to buy it, or let's say my stop is very tight. Okay, So let's say I sold below this. So let's say I saw this as an II and a final flag. I mean, this is not, but just for the sake of this example, and I sold here with a 2 or 3 tick stop, and it took me in and it stops me out, and the bar closes here. The technical stop is above this bar. It was not taken out, so the trade is still good. This bar, closed close enough to my original trade that I can re-enter here. So those are some of the only reasons to re-enter. When you're stopped out. In general, if you're stopped out, my opinion is you will get more clarity if you wait for 2 swings. You just wait for one more, couple more swings. It will tell you why you are wrong. So I think that's basically it. It's we've gone 20 minutes over limit, so we're going to stop here, and I'll make this webinar available for recording. And you have my email. Just send me questions and send me what you'd like to see during future webinars, and I'll try to create material around that. Okay. So thank you all for coming today, and I will